Owning a fishing boat sounds simple. Buy the boat, catch the fish, sell the fish, repeat. But here's the part almost nobody tells you before they sign the loan papers. Many fishing boats lose money without ever catching a single fish. The dock still charges a fee. The insurance company still sends a bill. The bank still wants its payment. And the engine keeps rusting whether it runs or not. In commercial fishing, the biggest expense isn't always the fishing part. Sometimes it's simply existing, scot with the boat tied up at the dock, doing absolutely nothing. Even sitting still, a mid-sized commercial vessel racks up somewhere between $5,000 and $25,000 a year just in dockage and slip fees, depending on the port and the size of the boat. Add hull insurance, which usually runs between 1.5% and 2.5% of the boat's value every single year. Add liability insurance to cover the crew. Add the loan payment, because almost nobody pays cash for commercial vessel. Add permit renewal fees just to keep the legal right to fish. Stack all of that together, and you get what the industry quietly calls the static burn rate. It's the amount of money that leaves your account every month, whether the boat catches 1 pound of fish or 1 million pounds. And here's the part that catches new owners off guard. Saltwater doesn't wait for you to go fishing before it starts destroying your boat. The moment a steel hull sits in a harbor, electrolysis and corrosion get to work. Barnacles and algae build up below the waterline. Moisture creeps into fuel tanks. Seals dry out. A boat sitting idle isn't resting. It's decaying at a rate of roughly 5 to 10% of its value every year simply from existing in saltwater. Two identical boats, same length, same engine, same fishing grounds, can produce wildly different profits. One is debt-free with a well-maintained hull, spending around $4,000 a month just to exist. The other carries heavy debt and higher insurance, spending $15,000 a month before it even leaves the harbor. Same ocean, same fish, completely different businesses. But before any of that fixed cost math even matters, you have to pick the right boat in the first place. And this decision alone can quietly decide whether the business survives. Not every fishing boat is built to do the same job, and the differences are not cosmetic. A small inshore lobster boat might cost somewhere between $150,000 and $450,000, run with a crew of 1 or 2, and burn a modest amount of fuel each day. An offshore trawler, the kind that drags heavy nets along the seafloor, can cost anywhere from $1.5 million to $6 million, needs a crew of 4 to 8, and burns through 50 to 100 gallons of diesel every single hour it's actively towing. A crab boat working the Bering Sea might run past $2 million before you've even added the pots. A tuna freezer vessel built for months at sea can cost $5 million and climb well past $20 million. Here's the trap. The wrong boat for the wrong fishery creates a financial disadvantage that never goes away. Put an enormous, fuel-hungry offshore trawler into a small, tightly regulated fishery with a low catch limit, and the fuel and maintenance bills will eat the boat alive before it ever turns a profit. And you can't simply retrofit your way out of the mistake. Converting a trawler into a crab boat or a long liner means ripping out deck machinery, reinforcing the hull, and getting new stability certifications, a job that can cost 30 to 50% of what the boat is even worth. Choose wrong at the start and you're paying for that mistake for the entire life of the vessel. Which brings us to how people actually pay for these boats in the first place. Because almost nobody writes a check for the full amount, most commercial fishing vessels are financed, not bought outright. And marine loans work differently than a car loan or a house loan. Lenders typically want a down payment of somewhere between 15 and 35% of the boat's surveyed value. Say you're financing a new boat worth $2.5 million. A 25% down payment is $625,000 in cash before you even start. Finance the rest at around 8% interest over 15 years. And you're looking at a monthly payment close to $17,000. Every single month. Rain or shine, fish or no fish, that monthly payment becomes a fixed cost the moment you sign the paperwork, long before a single net hits the water. And here's the trap inside the trap. The more debt you carry, the more pressure you feel to go out fishing in conditions you probably shouldn't, because staying tied up at the dock still costs you $17,000 that month either way. High leverage doesn't just create a financial risk, it creates a safety risk, because a captain under debt pressure is a captain more likely to push into worsening weather. Once the loan is signed and the boat finally clears the harbor, a new and far more unpredictable expense takes over almost immediately, and it can undo a season's worth of profit in a matter of weeks. Fuel is usually the single largest variable cost in commercial fishing, often eating up 30 to 50% of a trip's total expenses, and the physics of it are brutal. Pushing a heavy displacement hull through water gets dramatically more expensive the faster you go, because the power needed to maintain speed increases roughly with the cube of that speed. In plain terms, going just 10% faster can burn 30 to 40% more fuel. A boat cruising efficiently might burn around 12 gallons an hour. Push that same boat to near maximum speed and it can burn 20 gallons an hour or more, for barely any extra speed gained. Now imagine diesel prices simply double overnight, which has happened more than once due to global supply shocks. A trawler burning 500 gallons a day sees its daily fuel bill jump from around $2,200 to over $4,400. That's not a rounding error. That's the difference between a profitable trip and a trip that loses money the moment the boat leaves the dock. And fuel doesn't just threaten the trip that's already underway. It threatens the decision of whether to even leave the dock in the first place. Picture a captain staring at the fuel gauge and the weather report at the same time. Diesel prices have climbed for 3 straight weeks. The forecast shows a narrow window of decent weather, maybe 4 days, before the next system rolls in. Go now, and the trip is expensive but survivable. Wait for prices to settle, and the weather window might close entirely, costing an entire week of fishing days that can never be recovered. There's no perfect answer here. Every commercial captain runs this exact calculation, weighing the price of diesel against the price of time, because both of them are spending money whether the boat moves or not. If you're finding this breakdown useful so far, this is a good moment to hit subscribe and drop a like. It genuinely helps the channel keep making videos like this one. Even with fuel costs under control, there's one variable no amount of budgeting can fix, and it has ended more fishing seasons than bad math ever has. Unlike a factory, a fishing boat can't simply decide to operate on schedule. The ocean decides. When a storm rolls through or seas build past 8 or 9 feet, boats are forced to stay tied up or run for shelter. And while they sit there, revenue drops to zero, but the fixed bills, the loan payment, the insurance, the dockage, keep arriving exactly on time. Rough seas also make fishing gear dangerous or impossible to deploy, and they can shift water and cargo inside the boat in ways that genuinely threaten its stability. If a 5-day storm hits during a 2-week salmon opening, that's over a third of the entire season's earning window gone, permanently, while every fixed cost keeps ticking. Assuming the weather cooperates and the boat actually makes it out to the fishing grounds, there's still no guarantee of finding anything worth catching, and that uncertainty alone can define whether a trip makes money. A boat doesn't earn a dollar by simply floating around the ocean. It earns money by finding fish efficiently, and search without finding anything is one of the most expensive things a vessel can do, because it burns fuel and crew hours while generating zero revenue. This is why serious operators invest heavily in electronics. Long-range scanning sonar can run from $35,000 to $150,000. Fish-finding sounders add another $8,000 to $30,000. Add satellite positioning, net monitoring sensors, and sea temperature tracking, and a well-equipped boat might carry $70,000 or $80,000 in electronics alone. It sounds expensive, until you consider the alternative. A captain running blind, burning diesel while guessing where the fish might be. And once you actually find fish, the species swimming into your nets changes the entire economics of the trip, sometimes dramatically. Not all fish are created equal, financially speaking. Bluefin and yellowfin tuna can sell for $8 to $30 a pound or more. Wild salmon might bring $2.50 to $12 a pound depending on the run and the season. Cod and other ground fish typically sell for $1.50 to $4.50 a pound. King and snow crab can fetch $8 to $25 a pound, but with wild swings depending on the size of that year's harvest. Sardines and menhaden, harvested by the ton for industrial use, might sell for as little as 10 cents a pound, meaning those boats survive purely on massive volume. A boat rigged and licensed for high-value halibut that instead lands a hold full of low-value dogfish has burned the exact same fuel, ice, and crew hours for a fraction of the payout. And speaking of crew hours, paying the people on board works completely differently than almost any other industry, and it's worth understanding because it shapes everything about how a boat operates. Most commercial crews aren't paid an hourly wage. They work under what's called a lay system, where the crew effectively becomes a financial partner in the trip. Under the most common version called a clear lay, the boat's operating costs for that trip, fuel, ice, bait, are subtracted from the gross revenue first. Whatever remains gets split between the owner and the crew, often somewhere close to 50-50. So on a trip that brings in $100,000 with $25,000 in trip expenses, you're left with $75,000 to split, meaning both the owner and the crew pool walk away with roughly $37,500 each. The captain typically takes an extra cut on top of a full share, often 10 to 20% more, to reflect the responsibility of running the boat. This system protects the owner during a bad trip, because if the boat catches almost nothing, the crew earns almost nothing too. But it comes with a real cost. Skilled deckhands know this, and during prolonged slump, they simply leave for boats that are catching fish, or for steady work on land. There's also a quieter risk hiding inside the lay system. When a boat has a genuinely bad stretch, several trips in a row with poor catches, the crew's take-home pay can fall below what a steady job on land would pay for the same hours. Experienced deckhands notice this quickly, and they have options. They can walk onto a boat that's catching more fish, or leave the industry entirely for construction, trucking, or dock work with a guaranteed paycheck. That leaves the owner scrambling to replace skilled labor with less experienced hands right when the season needs the most competent crew on deck, which only makes a bad stretch harder to recover from. Keeping a good crew matters, but none of it matters if the boat itself falls apart, and saltwater is working against you every single day. Whether you notice it or not, maintenance on a commercial vessel never truly stops. Hulls need to be hauled out of the water every 12 to 24 months for anti-fouling paint and new sacrificial zinc plates, at a cost of $8,000 to $35,000 per hull out. Main engines need injector work, oil analysis, and turbocharger servicing, often $10,000 to $40,000 a year. Deck hydraulics, the winches and pumps that actually haul the gear, need regular attention too, or they fail exactly when you need them most. And here's the part that catches owners off guard. Skipping a $2,000 preventative service today doesn't save $2,000. It often leads to a $50,000 engine failure at sea, plus towing fees, plus lost fishing days, plus, in the worst cases, a total loss of the vessel. Even a perfectly maintained boat, however, is worthless without one thing that has nothing to do with the boat itself, and it can be worth more than the vessel it's attached to. In countries like the United States, fishing isn't a free-for-all. Under laws like the Magnuson-Stevens Act, access to most valuable fisheries is tightly restricted through permits and quotas. In many fisheries, you can't simply buy a boat and start fishing. You have to buy the legal right to fish, separately from someone who already holds it. In Alaska's halibut fishery, quota shares can trade for $45 to $70 per pound of annual catch rights, meaning the quota attached to a boat is often worth 3 to 5 times more than the boat itself. A single Bering sea crab quota allocation can be worth millions of dollars on its own. This has quietly changed the entire industry. Capital increasingly flows toward buying the legal right to fish rather than building a faster, bigger boat, because in a quota-controlled fishery, the permit is often the real asset, and the boat is just the tool that uses it. Once you've secured the right to fish and successfully caught something, the job still isn't finished, because raw fish is a product with a very short shelf life, and mishandling it can destroy most of its value in hours. Fresh-caught seafood starts breaking down almost immediately through bacteria and natural enzymes. Without fast cooling, a valuable catch can turn into a low-grade product before the boat even reaches the dock. Boats typically use crushed ice, refrigerated seawater systems, or blast freezing, and the ratio matters. In warm tropical water, you often need 1 ton of ice for every ton of fish caught, just to keep the hold cold enough. The financial stakes here are enormous. A tuna that's properly chilled the entire trip might sell for $12 a pound as premium sashimi grade. That exact same tuna, mishandled for even a few hours, can drop to $3 a pound as low-grade canning fish. Same fish, same trip, same fuel burned, 75% less money, purely because of temperature control. There's a version of this that plays out constantly across the industry, and it's worth walking through because it shows exactly how a good-looking decision can quietly become a bad one. Say a buyer picks up a used trawler at auction for $150,000, a boat that would have cost a full $1 million new. On paper, that looks like the deal of a lifetime, an 85% discount. But here's the catch nobody mentions at the auction. That boat has no fishing contract lined up, and it needs an overhauled engine before it can safely leave the harbor, which alone runs another $60,000. Add a slow first season while the new owner learns the fishing grounds, and by the end of year 2, the total money spent on that bargain boat is closing in on what a well-maintained, ready-to-fish vessel would have cost from the start, except this one arrived a year behind and with an unfamiliar engine. The discount was real, but so was everything the discount didn't include. Getting a perfectly preserved catch to the dock feels like the finish line, but selling it introduces an entirely new layer of unpredictability that the boat owner has almost no control over. Fishermen rarely sell straight to a restaurant or a customer. Most catch moves through auctions, processors, or wholesale dealer networks, and prices swing hard based on supply. When the weather is good and the whole regional fleet goes out fishing at once, dock buyers get flooded with product, processing plants hit their daily capacity, and the price paid per pound can drop sharply, sometimes within the same week. According to NOAA's own fisheries data, in 2023, American commercial fishermen landed roughly 8.4 billion pounds of seafood, worth about $5.1 billion at the dock. That's the entire country's commercial catch for a full year, and it shows just how much the price per pound can be squeezed by supply and global trade, leaving individual boat owners with very little control over what they're ultimately paid. Selling into an unpredictable market is one kind of risk, but commercial fishing also carries a much more immediate danger, the kind that insurance exists specifically to protect against. Commercial fishing consistently ranks among the most dangerous jobs in developed countries, and the insurance reflects that. Hull and machinery coverage typically costs 1.5% to 2.5% of the boat's value every year. Liability coverage for the crew, often required under laws like the Jones Act in the United States, adds another significant expense, because that law allows an injured crew member to sue the owner directly for negligence. Pollution coverage protects against fuel spills, and lenders often require a special policy called breach of warranty coverage, which protects the bank's interest in the boat even if the owner accidentally voids the main policy. None of this is optional if you want financing. It's simply the cost of operating something this dangerous, and it adds yet another fixed bill that arrives regardless of how the season goes. Insurance protects against total disaster, but it's worth pausing here to look at what an actual industry-wide disaster looks like, because it shows how quickly an entire fishery can be wiped out through no fault of the operators at all. In 2018 and 2019, unusually warm water spread across the Bering Sea off Alaska. Snow crab, which need cold water to survive, started dying off in enormous numbers. A survey in 2018 estimated nearly 12 billion snow crabs living in the region. By 2021, that number had collapsed to under 2 billion, a population drop of more than 90% in just 3 years. The fishery had generated an average of about $150 million a year for boat owners between 2012 and 2021, and brought in over $200 million in just the year before the crash. Then, in the fall of 2022, for the first time in the fishery's history, Alaska officials simply canceled the season entirely. Boats that had been paid off, insured, permitted, and fully staffed sat completely idle, with owners still covering loan payments, insurance, and dockage on vessels that were legally barred from catching anything. Keep that in mind, because it's not a story about bad decisions. It's a story about how a business built on a wild, living resource can lose its entire revenue stream almost overnight, for reasons that have nothing to do with how well the boat was run. Which is exactly why the timing of income throughout the year matters just as much as the size of any single catch. Fishing income doesn't arrive evenly across 12 months. It arrives in short, brutal bursts. A seasonal crab and salmon boat might generate almost nothing from January through May, then bring in over $200,000 in a single strong month during peak salmon season, then go quiet again for the fall and winter. Across the whole year, 80 to 90% of a boat's income might land inside a window of just 2 to 4 months. That peak season money has to cover everything. The slow months, the haul out in the yard, the tax bill, the loan payments through winter, all of it. Owners who treat a great month like personal spending money, rather than a reserve to be stretched across the entire year, are usually the ones who end up in a cash crunch the following spring, forced into high-interest short-term loans just to keep the boat legally operating. Given how much can go wrong with a single boat, it's worth understanding why some fishing businesses grow steadily for decades, while others quietly disappear after just a few rough years. The operators who last tend to do one of 3 things. First, they diversify across species and seasons, holding perms for groundfish